I need you to stop whatever you are doing right now and pay attention for the next 30 minutes because something happened this week that every single financial expert I respect is calling the most important monetary event of this entire decade, and almost nobody outside of professional investment circles is talking about it in plain language that ordinary people can actually understand. What happened is not complicated once somebody explains it properly. But the reason it is not being explained properly is because the implications are so large and so uncomfortable that most mainstream media outlets do not know how to frame it without sounding alarmist. So let me just say it directly, and then spend the rest of this video making sure you understand every single layer of what it means. For the first time since 1996, the world's central banks now hold more gold than US Treasury bonds. The world's most powerful financial institutions, the central banks of China, India, Japan, Brazil, Turkey, Poland, and dozens of others, have quietly, deliberately, and systematically stopped trusting American debt as the safest place to put their money. They did not announce it with a press conference. They did not send a letter. They just started selling America. And this week, the numbers confirm that the sale has officially begun in earnest. Let me give you the exact data first because I never want you to just take my word for anything. According to the World Gold Council and data cited by Bloomberg this week, the total value of gold held by foreign central banks has now reached approximately $4 trillion. Total value of US Treasury bonds held by those same foreign central banks sits at approximately $3.9 trillion. That is a $100 billion difference. Gold just overtook US debt as the world's largest foreign reserve asset for the first time in 30 years. And before you think this is just a gold story, I need you to understand something. This is not a gold story. Gold is just the instrument. The story is about what this shift tells us about where the world's most sophisticated financial minds, people who manage trillions of dollars with lifetimes of training and access to information you and I never see, where they think America is heading. Because central banks do not make moves like this based on emotion or headlines. They make them based on a cold-eyed, decade-long assessment of risk. And they have just told us in the clearest possible financial language what their assessment is. They no longer trust American debt the way they once did. Now let me explain what that actually means in a way that connects to your life and your money, because this is where I think most financial commentary completely fails the people watching. To do the macro picture without ever connecting it to what you are actually going to feel in your daily lives. So let me connect those dots right now. When foreign central banks buy US Treasury bonds, what they are really doing is lending money to the United States government. And the United States government uses that money to fund everything from military operations to Social Security payments to the interest on its existing debts. The demand from foreign central banks is one of the reasons that the US has been able to borrow at relatively manageable interest rates for decades. Because when there are many buyers for your debt, you do not have to pay them as much to attract them. This is basic economics. The more people who want to buy something, the lower the price the seller has to offer. When buyers start stepping away and the line of people who want to lend you money gets shorter, you have to start paying them more to keep them interested. And when you are the US government and your interest rate goes up, every single person in the country pays for it. Your mortgage goes up, your car loan goes up, your credit card rate goes up, the cost of running every business in America goes up. And the national debt, which is already $39 trillion, and growing at more than $7 billion per day, becomes more and more expensive to service with every fraction of a percentage point that rates rise. This is why the Sell America trade, which is what professional investors are calling what is happening right now, is not just a story about bonds and gold and central banks. It is a story about the future cost of living for every American family. And it is accelerating. Let me take you through exactly how we got here and what the specific numbers tell us about where we are going, because the timeline of this shift is one of the most important and underreported financial stories of this century. It started in 2022. On February 28th of that year, in response to Russia's invasion of Ukraine, the United States and its Western allies did something that had never been done before at this scale. It froze Russia's foreign exchange reserves, approximately $300 billion of assets held by the Russian central bank in Western financial institutions. For the global investment community, this was a historic shock. Not because anyone was defending Russia's actions, because it revealed something that central bankers around the world had always understood theoretically, but now had to confront practically. Your reserves are only as safe as your political relationship with the country holding them. If the United States decides, for geopolitical reasons, that it wants to freeze your assets, it can. And that reality changed the calculation for every central bank on earth that was not a close US ally. If you are the central bank of China or India or Turkey or Brazil, and you are sitting on hundreds of billions of dollars of US Treasury bonds, the question you now have to ask yourself is this: what happens to those reserves if US-China relations deteriorate? What happens if there is a conflict over Taiwan? What happens if Washington decides to use its financial infrastructure as a weapon the way it did against Russia? 2022 Russian reserve freeze was the moment that question went from theoretical to urgently practical. And the answer that dozens of central banks gave was to quietly start reducing their exposure to US debt and increasing their exposure to gold. The one asset in the world that has no counterparty risk cannot default, cannot be diluted by any government's policy decision, and critically, cannot be frozen by American sanctions because it does not live inside the American financial system. 2022 was just the acceleration of a trend that was already building, China's holdings of US Treasury bonds have been declining for years. At their peak in 2013, China held approximately $1.3 trillion in US Treasuries. By the end of 2025, that number had fallen to roughly $1759 billion. China has sold approximately $500 billion worth of American debt over 12 years. Japan, the largest single foreign holder of U.S. Treasuries at about $1.2 trillion, held its 10-year bond auction just 2 days ago and saw the weakest investor demand since May. The bid-to-cover ratio, which measures how much demand there is for every dollar of debt being sold, came in far below its 12-month average due to Japan's bond market, telling you that investors are less willing to park their money in government debt at current yields, and that reluctance is spilling over directly into demand for U.S. Treasuries because Japan has historically been one of America's most reliable creditors. And then there is Brazil, which is a story that barely anybody in American financial media has covered, but which is perhaps the clearest single data point about where this is going. Throughout 2025, the Central Bank of Brazil divested $61 billion of U.S. Treasury securities. At the same time, it doubled its gold holdings. $61 billion out of American debt into gold in a single year from one central bank. And Brazil is not an outlier. Poland, Turkey, India, Qatar, and China's People's Bank have all been buying gold at historic pace. The People's Bank of China has now extended its gold purchasing streak to 16 consecutive months as of February 2026. 95% of central banks surveyed in the World Gold Council's most recent study expect global gold reserves to continue rising through the end of this year. Here is the number that should make every American sit up straight. For the first time in recorded history, 0% of central banks surveyed said they intended to reduce their gold holdings. 0. Every single central bank in the world is either holding or buying more gold. None of them are selling. None of them. Think about what that tells you about the consensus view among the world's most sophisticated financial institutions about the direction of American fiscal credibility. Now let me talk about what triggered the most recent surge in Sell America sentiment, because this is where it gets very specific and very current and very relevant to what you're going to see happen in markets in the next 30 days. The Sell America trade, as Wall Street calls it, first appeared in its current form in April of 2025 during Liberation Day, when President Trump announced sweeping reciprocal tariffs on virtually every major trading partner the United States has. What happened in the markets during that week was something that had almost never happened before in the history of American finance. Normally, when there is a global crisis, investors run toward U.S. assets. They buy dollars, they buy treasuries, they treat America as the safe harbor. During Liberation Day, the opposite happened. Stocks fell, the dollar fell, and treasury bond prices also fell, which means yields spiked. Stocks, bonds, and the dollar all going down at the same time is the textbook definition of capital flight. Money leaving America entirely and going somewhere else. The dollar dropped nearly 6%. The S&P 500 fell over 12%. Long-term treasury yields jumped 40 basis points in 1 week. Krishna Guha at Evercore ISI put it perfectly when he told clients, "This is Sell America again within a much broader global risk-off." The term was born. And since then, it has come back twice. Once in January of this year, when the DOJ subpoenaed the Federal Reserve in a criminal investigation, and investors interpreted it as an attack on Fed independence, sending gold to a new record above $4,600 an ounce, while stocks, bonds, and the dollar all fell simultaneously. And again this week, as the Iran war grinds on, oil stays above $100 per barrel. The OECD revises its U.S. inflation forecast sharply higher, and central banks are confirmed to have crossed the historic threshold of holding more gold than U.S. debt for the first time since 1996. Here's why this particular moment is different from the previous episodes, and why I think this one does not reverse as quickly as the others did. Every previous Sell America episode had a clear mechanism for reversal. When Liberation Day scared markets in April 2025, Trump paused most of the tariffs and markets snapped back. When the Greenland crisis rattled markets in January, Trump softened his rhetoric and markets recovered. What is happening right now is not driven by a reversible policy decision. It is driven by something structural. The people who are selling American debt and buying gold are not doing it because of one tweet or one tariff announcement. They're doing it because of a decades-long calculation about the sustainability of U.S. fiscal policy that has now reached a conclusion. The U.S. government spends nearly 23 cents of every dollar of revenue just on interest payments. The national debt has crossed $39 trillion. The debt is growing at more than $7 billion per day. $9 trillion in existing Treasury debt is being refinanced this year at interest rates that are 4 to 6 times higher than when that debt was originally borrowed. And the country is simultaneously fighting a war in Iran that the Pentagon has asked for $200 billion to fund, adding to a deficit that already has no credible path to reduction. The people running the central banks of China, India, Brazil, and Turkey are not selling American debt because they read a tweet. They are selling it because they ran the numbers and concluded that a country this deeply in debt, with this level of political dysfunction around its central bank's independence, with this level of geopolitical overreach, and with inflation running this far above its targets, is no longer the risk-free safe harbor it once was. And when institutions with trillions of dollars of capital under management reach that conclusion, even gradually, even slowly, even over years, the effects on ordinary Americans are profound and they compound over time. Every year that foreign central banks reduce their appetite for U.S. debt, the government has to pay more to attract new buyers. Every basis point of higher interest rate on the national debt is tens of billions of dollars in additional interest expense. That is money that is not building roads, not funding schools, not covering healthcare, not reducing the deficit. It is just the cost of having borrowed so much that the world is starting to ask for a higher premium to keep lending. Let me talk about what this means for the dollar, because I think the dollar story is the most important and the least understood piece of this whole picture for ordinary Americans. The US dollar has held the status of world reserve currency since the Bretton Woods Agreement after World War II. What that means in practice is that international trade, oil contracts, commodity markets, and central bank reserves are all denominated primarily in dollars. It creates what economists call the exorbitant privilege. Because the world needs dollars to do business, the United States can essentially print money and spend it globally without immediately paying an inflation penalty. Americans get to live beyond their means at a scale no other country can match precisely because the world needs to hold dollars. But here is what is happening. In 2025, the US dollar index, which measures the dollar against a basket of other major currencies, fell more than 9%, its worst single-year performance in 8 years. And that decline is not driven by one policy or one event. It is the aggregate signal of dozens of decisions by dozens of institutions and governments around the world to reduce their dependency on and exposure to the dollar. De-Dollarization is the technical term for it. And it is no longer a fringe concern or a theoretical future scenario. It is happening right now, measurably in the data this week. Ray Dalio, founder of Bridgewater Associates, one of the largest and most successful hedge funds in history, said it directly at the World Economic Forum in Davos in January. He said, on the other side of trade, deficits and trade wars, there are capital and capital wars, and maybe there is not the same inclination to buy U.S. debt. Dalio has been saying for years that we are in a historic period of transition from one global monetary order to another. He's been saying that the debt and monetary cycle that has governed the global economy since 1944 is ending. And what happened this week, gold overtaking US Treasuries as the world's largest foreign reserve asset, is exactly the kind of concrete milestone that marks a transition from one era to another. These transitions do not happen overnight, and they do not resolve in a single direction without volatility in both directions along the way. But they do happen. It have happened before. In 1971, when Nixon closed the gold window and ended the Bretton Woods system, it happened. In the 1930s, when sterling lost reserve status, it happened. These are rare events in human history. But they are not unprecedented. And every time one has happened, the country that lost reserve currency status paid an enormous economic price. Now, let me connect all of this directly to your money and what you should be thinking about right now. Because everything I've told you so far is context. What matters is what it means for the people watching this video. The first thing you need to understand is that the Sell America trade in its structural form means that the traditional rules for building a portfolio no longer apply in the same way. For decades, the standard advice was to hold stocks for growth and treasury bonds for safety, because bonds would go up when stocks went down and act as a shock absorber for your portfolio. What happened during Liberation Day in April 2025, and what has been happening episodically since then, is that stocks, bonds, and the dollar are all falling at the same time. That is the signature of the Sell America trade. And when bonds no longer provide the hedge they once did, you need to rethink what provides that hedge for you. The answer that the world's central banks are giving you with their actual money and their actual decisions, not their words and not their recommendations, is gold. The second thing you need to understand is that the interest rate environment you are going to face for the rest of 2026 and potentially beyond is not going to be the low rate environment that fueled the stock market rally of the past decade and a half. The Federal Reserve is trapped, with inflation running above its target, with oil above $100 a barrel, with the OECD forecasting U.S. inflation at 2% for this year against the Fed's own projection of 7% just weeks ago. The Fed cannot cut rates without making the inflation problem worse. And if foreign demand for U.S. Treasuries continues to decline, Treasury yields will rise structurally regardless of what the Fed does, because the market will demand higher compensation for the perceived additional risk of American debt. Higher Treasury yields mean higher mortgage rates, higher auto loan rates, higher corporate borrowing costs that squeeze profit margins, higher interest on your credit card debt. This is not theoretical future risk. This is the mechanical chain of consequences that follows from what happened this week. The third thing you need to understand is what this means for the stock market in particular. The S&P 500 entered 2026 at what the Nobel Prize-winning economist Robert Shiller's research identifies as the second most expensive valuation in 155 years of data. The only time it was more expensive was the dot-com bubble. The stock market has since fallen more than 7% year to date, and the Nasdaq has entered correction territory, falling more than 10% from its January high. And the specific reason why high valuations are so dangerous in this particular environment is that the value of a stock is essentially a calculation about future cash flows discounted back to the present. When interest rates are low, future cash flows are worth more today. When interest rates are high or rising, those same future cash flows are worth less. To Sell America trade by putting upward pressure on Treasury yields, is structurally repricing the entire stock market downward. Not because the companies themselves are doing worse necessarily, but because the mathematical framework for valuing them has changed. Goldman Sachs has quietly warned that severe disruptions to global oil supplies could drag the S&P 500 down to 5,400 this year. That would represent a 22% decline from its January peak and would by definition constitute a bear market. That warning came from Goldman, not from a podcast, not from a financial influencer. Goldman Sachs. It was based on the oil shock alone, before you factor in the structural repricing pressure from declining foreign demand for US Treasuries. So what do you actually do with all of this? Let me be very specific and very direct, because vague financial advice is useless to you. The single most important thing you can do right now, if you have a portfolio that was built on the assumption that bonds would protect you when stocks fell, is to accept that this assumption has changed and adjust accordingly. It does not mean panic. It means rebalancing. The world's central banks have given you the clearest possible signal about where they see safety. They are moving from paper assets that carry counterparty risk and can be frozen by geopolitical decisions into physical assets that carry no such risk. Gold has now surpassed US Treasuries and central bank reserves for the first time in 30 years. If you have zero gold exposure in your portfolio, you are positioned differently from how every central bank on earth is now positioned. Does not mean you should move your entire portfolio into gold, but a 5 to 15% allocation to precious metals provides the kind of inflation and geopolitical insurance that bonds used to provide and no longer do in the same way. The second thing is to audit your sensitivity to rising interest rates. Any long-duration bond holdings in your portfolio are exposed. When yields rise, the price of existing long-duration bonds falls, sometimes significantly. If you own a mutual fund or ETF that holds long-term US Treasury bonds, you need to understand exactly how that position performs if yields continue to rise as foreign demand for US debt structurally declines. Short-duration bonds and Treasury inflation-protected securities, called TIPS, provide better protection in this specific environment than long-duration conventional bonds. Talk to a financial advisor about your specific situation, but understand the general principle that in a rising yield environment driven by declining foreign demand, long duration is risk. The third thing is to understand that the dollar weakness embedded in the Sell America trade is actually good news for specific parts of the US stock market. When the dollar weakens, American companies that earn revenue in foreign currencies see those revenues translate back into more dollars. Large multinational corporations with significant overseas operations historically outperform when the dollar is falling. This is a rotation opportunity, not just a crisis. To companies and sectors that benefit from a weaker dollar and from higher commodity prices, energy companies, materials companies, real assets of all kinds, are the places where the Sell America trade creates opportunity rather than just pain for investors who are paying attention. The fourth thing, and this is the one that I think most people miss completely, is to understand what this shift means for the most important financial relationship in your daily life, the relationship between you and your bank. U.S. banks hold trillions of dollars in treasury bonds on their balance sheets. When yields rise, the value of those bond holdings falls. This is exactly what drove Silicon Valley Bank's collapse in 2023, when a much smaller and much more contained rise in yields created unrealized losses on bond holdings so large that depositors panicked and the bank failed in 48 hours. The FDIC currently has 60 banks on its problem list. The U.S. banking system is carrying tens of billions of dollars in unrealized losses on its securities portfolios. If the Sell America trade pushes Treasury yields meaningfully higher over the next 6 to 12 months, those unrealized losses will grow. And while most large banks are nowhere near the point of collapse, the direction of the risk is important to understand and monitor. Make sure you understand what your bank is exposed to. Make sure your deposits are within FDIC insurance limits. Make sure you have liquidity outside the banking system, whether in physical assets, in diversified accounts, or in instruments that are not correlated to the same risk factors. We bring this together with what I think is the most important historical lesson from every previous reserve currency transition, because I have studied these transitions carefully. And there is one pattern that repeats itself every single time, and it is the pattern that ordinary people always get caught on the wrong side of. When the world shifts from one reserve currency to another, the transition does not happen in a single dramatic moment that everybody recognizes and responds to in real time. It happens slowly and then suddenly. It happens in 100 small signals over years that most people ignore or dismiss, and then it culminates in a series of events that happen so fast that people who were not already positioned have no time to adjust. The British pound lost reserve status gradually between roughly 1914 and 1945. During that period, there were many moments that looked like recoveries, many moments when the pound bounced back, and people concluded that the end of sterling dominance had been exaggerated. And then in 1944 at Bretton Woods, the dollar replaced sterling as the world's reserve currency officially and essentially overnight in institutional terms. Two people who had moved assets into dollars gradually over the preceding years came through that transition in good shape. Two people who had waited for a definitive signal that it was happening faced a completely different reality. I'm not telling you that the dollar is about to be replaced next week or next year. I'm telling you that the central banks of the world are positioning for a world in which the dollar's primacy is shared and diminished, and they have been doing so measurably for years, And this week we crossed a threshold that confirms the trend is structural rather than cyclical. Gold now represents 24% of global central bank reserves. US Treasuries represent 21%. That gap was the opposite 30 years ago. Treasuries were at 33% and gold was at 9%. This is not a small shift. This is a fundamental reordering of the global reserve hierarchy, and the people who understand what it means and position accordingly are the ones who will come through the next decade in good shape. Because here's the thing. Sell America trade is not the end of America. America is still the largest economy in human history. American companies are still among the most innovative and productive in the world. The dollar is still the dominant currency in global trade and will remain so for years or decades to come, even as its share of reserves declines. What is changing is the premium that the world has historically attached to American assets. The exorbitant privilege, the ability to borrow cheaply because everyone wants your debt. That premium is being reduced, gradually, structurally, by the most sophisticated financial institutions on earth making deliberate long-term decisions. And when that premium is reduced, the cost of living in America goes up, the cost of debt goes up. The standard of living for people who have not positioned their savings to account for this new reality goes down in real terms over time. Preparation is not panic. Preparation is paying attention to what the data is actually telling you and making rational adjustments before you are forced to. The data this week told you something specific and historic. For the first time in 30 years, the world holds more gold than American debt. The Sell America trade is no longer episodic. It is structural. The dollar's reserve premium is eroding, and the window to position yourself ahead of the consequences of that erosion is the window that is open right now, while most people are still reading headlines about oil prices and stock market corrections without understanding the deeper current that is running underneath all of it. The deeper current is what I showed you today. And now that you have seen it in the real numbers, you cannot pretend it is not there. The only question is what you do with it. If this video helped you understand something that your bank, your financial advisor, and your evening news did not explain to you, then do 3 things right now. Subscribe to this channel and turn on the notification bell because I am tracking this story in real time as it develops. And I translate it into plain language that actually connects to your life. Share this video with someone you care about who has savings, a retirement account, or a mortgage. Because the story I just told you affects all 3 of those things, and most people will not hear it anywhere else. Drop a comment below telling me what part of this surprised you most, because I read every comment and your questions shape what I cover next. The world just started selling America. That sale did not begin this week, and it will not end this week. But this week is when the numbers confirmed what the world's most powerful financial institutions have been quietly signaling for years. And knowing that is the difference between being ahead of this story and being caught by it.